Good evening. This is Coach Mike from WinningsTockCoach.com presenting to you my market overview for this week. It's been kind of a rough couple weeks, really, with determining, this market high point, which we were pretty spot on a couple weeks ago, expecting this pullback. But will be the first to admit that I expected it to pull back more in this past week. It got a bit of a jump up. So let's talk about things a little bit different than what we've talked about in past videos. I've tried to keep things pretty simple in the presentation that I've done on the market overview videos, and I want to do that, but I want to do that in a slightly different way. In the past, we've been looking at some mountain charts and using channels to keep things real simple. Tonight we're going to talk about some of the day-to-day moves and expectations we might be able to have going forward here. So the first thing I want you to look at, and I know there's a bunch of lines, and I'm going to explain what every one of these lines is, so stick with me for a moment. What I want to show you first is, the pattern that was created here. From the lulls in December to the lulls that went into January, early February, we had the market create a lower low. And what we're looking at here is the SPX. This chart is the S&P 500. For those of you that are joining us for the first time, the S&P 500, one of the indice charts that we study in our market overview. Now, since then, the market went up and did create a new high. And on a dip that we would say is a higher low from this low, then came up this past week, and on Friday made a new all-time high before retreating pretty well from it. Now, what I want to point out here is going to start with this purple line. This purple line, just a simple trend line you can mark on your charts. I connected here from the low on February 5th, just through the bottoms this past week. Made a bit of a ascending channel line. Now, I also went through the highest close with a horizontal line. Now, what you see is we were actually just barely at a new all-time high on Friday. And many people would call this a double top, and I'm going to call it that as well. The reason I put my horizontal line across the close, the highest close, is because, let's face it, when you're watching the evening news, when you're seeing the stuff go across the bottom of the screen, it's the closing price that you're seeing. It's the closing price that you're faced with staring at all night long until the next market day, when you're looking in relation to your balance in your brokerage account. So that's what we're going to talk about, and that's why I reference this. Now, there's a very important technical pattern on a chart that is potentially a really big pattern to trade both to the bullish and the bearish side. Now, that chart pattern is known as an ascending triangle. And what an ascending triangle is a time where the lows get higher, but the tops stay the same. And even though I like an ascending triangle that gives us a little more time than what this one does, it is still an ascending triangle nonetheless. It's still a double top nonetheless. A double top is nothing more where two tops are at equal or very close to equal price. And while many people would argue that it could be a bullish or bearish indication, I'm going to say that it's neither until it does something from it. And here's the importance of that. So regardless if this is an ascending triangle, regardless if it's a double top, here's the importance. The importance is it has to close above this line. This horizontal line that I've marked, the pink line here on the chart, we have to close a day above this line. Closing a day above this line would give us validation, verification, whatever you want to say, of one of two extremely bullish chart patterns. Whether it be a double top breakout or an ascending triangle breakout, the breakout that we'd be looking at would be one where it breaks the horizontal line, it breaks the double top, breaks the ascending top where the tops have remained the same, and potentially push us forward on the SPX to 1942.29. So let me explain this number and how I got it. This was derived using a tool called Fibonacci extensions. Fibonacci extensions are a 3-point tool that mathematically equate the space between prior moves when projecting a bullish target. You are going to connect from a low to a high into the subsequent low. In doing that, what you're actually using the tool to equate is saying, for instance, with the line I have, you can see it starts at this low. I ran it to this high. Why? Because during November, December, we didn't really pull back. We went sideways. Then we pulled back. So I went low, high, low. And what this number is representing, the 1942.29, is that if the S&P 500 replicates the percentage move made from this low on October 9th to the high on January 15th, that from this low, the same percentage move would draw us to 1942.29. So, should we get a breakout above that ascending triangle top, above the double top, we would be seeking an S&P 500 price 1942.29, plain and simple. Now you can also use this tool for the bullish side, where you would connect a high, a low, and a high, projecting for a pullback point to replicate the same percentage move of a prior pullback. Before we get into that, I want to explain the bearish side of these two chart patterns. This would be, for instance, on our ascending trend line. If we were to fail this trend line without breaking out above that double top area, all of a sudden this pattern gets extremely bearish. And at that time we do see that the double top resistance was a formidable foe, and the price will begin to drop. How far? Well, that's why we're going to use some other tools and explain those in a second. And also just the double top in general. If it begins to pull back, and especially pulls back lower than the low that was created here on March 14th, that would basically signify or validate the bearishness of the double top chart pattern. So let's talk about my Fibonacci extensions that are colored in red. I color these red, unlike the green ones that are bullish target, because red are my bearish targets. By using the high over here on 3.7, the low on 3.14, and again the high from Friday, if we were to get a mild pullback, just a mild little pullback, we could actually see a bounce from 1839.97, which would throw out the ascending triangle. That would be gone. This trend line would obviously fail, and it would be gone, but it is reason to believe we could simply bounce from that number, which would actually then, even though only pennies from it, be a higher low than the low from March 14th, or one could even say, because of how close they would be, that it would be a double bottom, which, so long as that support is held, could be a bullish chart pattern. Now, what the important thing will be on a pullback is if the 1839.97 fails. Now, because of this low here, and then the higher high that followed, we would be projecting from the high over here to our low on February 5th, and again the market high that made this past Friday, we would be projecting a potential pullback that would still lead to a higher low at 1771.05 for the S&P 500. So these values, I used my Fibonacci extension tool exclusively to project price targets, and they are regularly accurate within probably within 1.5%, to the point where I trade personally with a heavy dependency on them for technical guidance. So I want to keep things really, really simple this week. I don't want to talk about the weekly, and like we've done in the past, you can check out the previous market overview videos. You'll see my weekly channels. You'll see the explanations of when new trend lines were created. But let's talk about what is happening and what we need to expect off of it, because I truly believe that the S&P 500 is going to show us on Monday, Tuesday, or Wednesday the move it wants to make from this pattern. Why do I say Monday, Tuesday, or Wednesday? Well, it is possible on Monday the 24th we could have a little candle that fits in this territory. On the 25th, we could have a little candle that fits between that ascending line and the double top line. But on Wednesday, we meet what's called the apex point. That apex point means on the 27th, Thursday, the candle that's created would have to be above or below the ascending triangle pattern. So no matter how small things could be Monday or Tuesday, and Wednesday really, really small, it has to show us that move, because it could force a bullish or bearish pattern regardless if it waits till Thursday. So that's what I'm expecting this week, and that's why we're going over it a bit in the daily perspective. So I want you to understand, a break above, a close above this pink horizontal line based off of our highest market close, which was March 6th at 1881.94. If we can close a day above there, using that value as our support, so long as the support holds, I believe that we would be poised for a bullish move to 1942.29. Should we fail this ascending line? Should we fail this upwards moving trend line? We would first need to look for a potential bounce point at 1839.97. And should that fail, we could have a pullback that kind of resembles what we saw in January and would bring us down to 1771.05. Now, I don't want you to be scared of that either, because I want to show you over the past year, April, and then through May and June of 2013, June, July, and then August 2013, August, September, and into October 2013, we replicated the same type of move regularly, each time making higher highs and higher lows, so it was okay to pull back. So don't fear the potential that something could pull back. Actually, look forward to it, because again, many stocks are overpriced. And that pullback gets them down to the point where you can trade them. Those of you that are investing long term in many of these stocks, until this 1771.05 has failed, no danger whatsoever. Really until the 1737.92, because if you're trading for the longer term perspective, investing in a stock, so long as that stock makes higher lows, you should be investing and monitoring your stock more so based on where your stop point is and not where the potential highs are. You'll end up selling and watching it run higher every time. So longer term investing, trade according to where your stop is, where those lows are. But for the individual trader, the shorter term trader, we would love to see them come on down to where they could be made more suitable for trading. Stocks, all stocks in general, because the stocks follow the indices. And so we could progress with our next move up. But traders also know the bullishness of a potential ascending triangle pattern, the bullishness of a double top breakout, and what those can do to reward you in your short-term trading philosophies and your short-term trading experience. So now let's look over at the DJI chart. This is the Dow Jones Industrial Average chart. And unlike the S&P 500, where after January's pullback into early February lows, we made higher highs, the DJI has actually come and made a lower high. So let's take a look at that and make sure you understand where I'm going with it. You had this low down here in December, and you made a lower low from it, and that lower low so far has resulted in a lower high. But the subsequent pullback here, actually, one could argue that it gave you a higher low and is still bullish in the current pattern due to that low not exceeding more than 50% of the move and not creating a lower low yet. Now, I'm going to move this chart a little bit so we can see some of these potential target areas. And something really important to show here is where the S&P 500 made a new all-time high on Friday. The Dow Jones Industrial Average didn't. It actually made another lower high and retreated. I want you to look down here. Look at this volume bar. Look at this volume bar. You have this nice steady volume for a month and huge volume on a day that retreated quite heavily. So let's talk now in relation to our bearish Fibonacci extension price projections. Marking from the high on March 7th to the low on March 14th, and then to Friday's high, which is, as you can see, a lower high. Now, this is also assuming that Friday's high is not broken. That's one thing you have to understand with the Fibonacci extensions. Basically, your 0% line, your marking line, if the price ever goes above that, or if it's the green one, if you're using it to project a bullish target, if it goes below it, it's going to alter your price target. And you would need to alter with your tool to follow that move. Now, should that high from Friday hold as the current high and confirm to us that the market made a lower high, we would be expecting 15,997.74, which is a lower low from that made on March 14th. Why would we project a lower low? Well, because we had a lower high. And if the lower high sticks, we're probably going to get a lower low and an interim bounce off of that area. Now, if 15,997.74 fails, because of the high made on December 31st, the market low on February 5th, and then the high from this move up on March 7th, if that 15,997.74 on the DJI fails, we would be left to anticipate a lower low from the entirety of the move and a potential bounce target at 15,258.14. But, hey, if that S&P 500, the SPX, does that ascending triangle breakout that we were just speaking about, we would see the Dow Jones Industrial Average break this zero line at 16,505.70 and result in the same type of trade, giving us a breakout projection of 17,209.51. My only concerns with a market breakout is, rather than pulling back in mid-December, as the market was due to see, it actually had a breakout. And because of the breakout without a healthy pullback, the subsequent pullback is usually excessive, which is what we saw in January. So if we are fortunate enough to see the market breakout, the S&P 500 break out of the ascending triangle, the DJI would be an ascending triangle at that point as well, and we see these high projections, it'll actually force us to take profits on trades and long-term investments, while not necessarily selling all of an investment, but taking profits on it, on part of the position, knowing and understanding that the subsequent pullback will be expected to be a bit more excessive than what is the normal. And finally, that leads us to the RUT, which is the Russell 2000, commonly known as the small cap index. And we see the same type of pattern. We see this, well, it's still showing a bit of a lower high, but a higher high made here on the March 4th high than we came down from in late January. Using my market low on 2.5, the high on 3.4, and the low of 314, it's given me a bit of a bullish projection up to 1301.97. Now that's going to be if the S&P 500 makes that breakout, that ascending triangle breakout, if the DJIA makes the same breakout we just spoke about, and the RUT basically breaks out and makes a new high. We would use the prior high close of 1208.65 as our stop out point, as our support level, and we would play the breakout, trade for the breakout. Should we fail and begin to pull back from this point, from this lower high that so far has been made from Friday, then we would be looking at 1167.79 as a shorter term bounce target, which would be a lower low than the March 14th low. But that would also be assuming that this high made Friday was a lower high from that made on March 4th. And then should that fail, 1113.50 by projecting the high from January 22nd, the low on February 5th, and the high on March 4th to give us that projection, which would still be a higher low for the Russell 2000 in general. So, not to be confusing in any aspect, I want you to understand that the particular chart patterns that we're seeing on our daily charts make it so that you literally have to plan for both scenarios. You have to plan for the bullish breakout. You have to plan for the bearish breakdown. Why? Because until it makes its move, either one has, it's literally a 50-50 chance in a trader's world. It's going to do one of the two things based on the chart patterns we see. They're highly reliable chart patterns. As a matter of fact, if you watch my live trade video from our chat room in the Coaches Roster chat room from FMCC and FNMA a couple weeks back, you'll see the ascending triangle breakout, the retest on that breakout, and then we live traded a bounce trade due to this highly reliable chart pattern. Doesn't always only work in little cheap stocks. I trade this chart pattern in any stock I see because of the high trade probability, high profit potential created from either side, breakdown or breakout. So understand that the reason I'm giving projections for downside targets and upside targets is because of what is required in your trade planning for these chart patterns. This is Coach Mike from winningstockcoach.com. I thank you for the opportunity to present to you the market overview I have for this upcoming week. I do encourage you, because of us discussing things on the daily aspect, and normally we're really talking the week by week, I really encourage you to subscribe to my YouTube channel and watch the previous market overview videos. Get a better idea, if you haven't seen them already, for the weekly channels and the discussion I've made on it, and the accuracy that we've had in our discussions on it. Remember, by no means have I ever, or will I ever, try to do like the media does and scare you in or out of positions at the worst times possible. I simply try to outreach and show you what you do need to expect, and not to fear anything, but just to have a plan ready for should something happen. Should a certain instance occur, be ready for, if this happens, I do this. And then rather than panic, simply make a decision.